Welcome back to another update of Smart Stock Sam. If you are really interested to make money out of US stocks, do not forget to subscribe and tap bell icon, because on this channel I deliver timely updates before crowd arrives. Alright, here we go.
What if I told you the most disruptive weapon in the 2026 electron volts war isn't a battery breakthrough or autonomous driving? It's something way more unexpected. Something that's making Tesla and Xiaomi's CFOs lose sleep at night. Stay with me, because this changes everything about how we think about electric vehicles. Welcome to this $260 NIO strategy will disrupt the entire EV market, and by the end of this video, you'll understand why NIO just moved the battlefield from the showroom to somewhere nobody saw coming. Here's what's happening. The battlefield has fundamentally shifted from the factory floor to the capital structure. While every other EV maker is obsessing over horsepower and range specs, NIO is laser-focused on something completely different: SOFR plus 450 basis points and strict EBITDA to interest covenants. I know that sounds like financial jargon, but here's why it matters. The war isn't being fought with better motors anymore. It's being fought with spreadsheets. And NIO just figured out how to turn finance into a weapon. So why is cutting-edge hardware suddenly taking a backseat? Simple. Because in 2026, tech is no longer the differentiator, it's table stakes. Everyone has impressive 0 to 60 times. Everyone has advanced chipsets. Tesla, Xiaomi, Xpeng, they're all playing the same tech game. This is a brutal war of attrition now, and throwing more specs at the problem won't work. To win, you don't out-engineer the car. You out-engineer the buying process. You remove every bit of friction between a customer and ownership. And that's exactly what NIO is doing with a move that's absolutely terrifying the industry. This is weaponized finance, and the numbers look almost like a typo. NIO is rolling out commercial financing so aggressive it shouldn't even be possible. An 84-month loan term with an annualized interest rate of just 0.49%. Let that sink in. For their mass-market vehicles like the ET5 or the new Envo sub-brand, that translates to a monthly payment of just $260. While consumers see a dream deal, there's a hidden mechanism behind these numbers that completely redefines how we value a car. And once you understand it, you'll see why legacy automakers are panicking. To grasp this mechanism, we need to understand how NIO has redefined the vehicle itself. They're forcing a fundamental transition from viewing the car as an asset to viewing it as a utility. Think about it. $50,000 upfront is massive friction. It's a psychological wall that stops most people before they even start. But NIO applied a subscription economy mindset to a 2-ton vehicle. They turned a massive purchase decision into a zero-friction monthly utility payment. It's the Netflix model, but for your daily commute. You're not buying a depreciating asset anymore. You're subscribing to transportation. Now here's the problem everyone faces with long-term car loans. What happens if the tech becomes obsolete before your 84-month loan is even half over? You're stuck paying for yesterday's technology. That would be a disaster, right? NIO saw this coming from miles away. That's exactly why they created what I call the 7-year hedge. Their entire philosophy can be summed up in one brilliant phrase: marry the chassis, date the battery. Your loan agreement is locked in for 7 years, sure. But your battery technology? Completely unlocked. Through their battery swapping infrastructure, someone who buys in 2026 can swap their standard range battery for cutting-edge future chemistry in 2031 without changing their monthly payment. It's the ultimate insurance policy against tech obsolescence. Your car never gets old, even though you're still paying for it. But here's the question everyone's asking. How can NIO possibly afford to subsidize these insanely low interest rates? The answer is counterintuitive, and it's hiding in the factory. This is the operating leverage gamble. NIO's strategy is deceptively simple but brutally effective. Spend $1 on financing subsidies to save $2 on fixed cost overhead. By using those impossibly low monthly payments to flood the order book, especially for the Envo brand, they're driving their NIO Park factory toward 90% utilization. And when you hit that kind of volume, unit costs collapse dramatically. The cheap loans essentially pay for themselves through pure manufacturing efficiency. It's financial jujitsu. Now you might be thinking, Why not just cut the price of the car and skip all this complexity? That seems easier, right? Wrong. That would actually be a rookie mistake, and here's why. In strategic finance, you have to choose between the sledgehammer and the scalpel. A direct price cut is a sledgehammer. It destroys residual values overnight and angers every existing owner who just paid full price last month. You damage brand equity, and you can never raise prices again without looking desperate. Low-interest financing, on the other hand, is a scalpel. It maintains the sticker price, protects brand perception, and preserves residual value, while still surgically lowering the monthly friction for new buyers. It's the same outcome for the customer, but without the brand damage. That's genius-level strategy. So what's the final verdict on this radical shift? Here it is. NIO has realized that the most exciting innovation in 2026 isn't under the hood, it's in the loan agreement. They're winning on the spreadsheet by making the math of ownership absolutely undeniable. If they can maintain their interest expense covenants while scaling this utility model across their lineup, they won't just survive the EV wars. They'll have completely rewritten the rules of mass market adoption. And every other automaker will have to follow or die. The question isn't whether this strategy is bold. The question is whether traditional automakers can adapt fast enough before NIO captures the market. What do you think? Drop your thoughts in the comments. And if this analysis opened your eyes, hit that like button and subscribe for more deep dives into the strategies reshaping entire industries. Thanks for watching.
All right, that's the update. If you want more quick fact-based insight like this, subscribe and tap the bell icon so you don't miss the next one. Drop your thoughts in the comments, and I'll see you in the next update on Smart Stock Sam.